Hello everybody, Randy Patrick here. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. It's been turning the past couple of days. We've got some interesting news to share with you today. And by the way, it's Thursday, the 23rd of January. We're right in the middle of winter. New statistics came out. We'll talk about that today. I hope everyone's doing well. It's actually, we've had a couple of really cold days here in Central Florida. Got down to about the mid to high 30s. In the nighttime, it's going to be 75 again tomorrow. So that's the way it goes. We've had our 2 days of winter, so to speak, down here in Florida. All right. By the way, I'm going to be getting some contact management software and implementing that because I know I owe a lot of people some contacts. Been very busy with a lot of properties. I do want to get more information out to those who've inquired with regards to real estate investing products, buying a home, selling a home, and or investment properties down here in my area. So I'm working on that. Should get back to everybody by the weekend. All right, today will probably be a bit of a longer video. I'm going to give you a heads up on that. Reason being, we got a lot to talk about, a lot going on. This is the time of the usually third week of the month when we get all the statistics that come in from some of the some of the people that we rely upon for our housing information. And also, if you're not already a subscriber, please help my channel grow. Click the subscribe button on the bottom right of the video here. I'd appreciate that. And I want to give a heartfelt thanks to all the people who subscribe, who watch my videos. We've hit another benchmark at my channel over the weekend. I think it was Sunday or Monday. I saw we did break the 10,000 subscriber mark, so I do appreciate that. It's been a long time in coming, so I'm glad to get there. And again, obviously couldn't done it without people who are watching the videos and subscribing to my information. So once again, I appreciate that very much, and thank you for the support over the past year and a half. So there you go. So here we go. So let's get into this right now. I've got my papers reversed, so let me do a little quick re-reverse on my papers here. And the number one, so we're going to talk first of all about existing home sales. So of course, this is around the 22nd, 23rd of the month. NAR, National Association of Realtors, releases their existing home sales report. This is for December. And it's, according to National Association of Realtors, existing home sales climbed 3.6% in the month of December. On a full year basis, the amount of, because at the end of the year, the amount of homes that moved were about 5.34 million homes were bought and sold. That's existing homes. And it was, funny enough, the same level of 2018. So didn't really gain or lose, kind of maintained the same level of sales volume activity. But if you want to take a look at the regional breakdown, the South was up 2.2% prior to the previous year. There's a decline of 1.8% in the West. Midwest decline of 1.6%, and the Northeast remained unchanged. So really, we had increase in activity in the South, Northeast unchanged, and the Midwest and West lost a little bit of sales activity. So that's the scoop on that. So if we want to get into the numbers here, 5.4 million sales. It was a for the year, 3.6% month-over-month increase, a 10.8% year-over-year increase with respect to December 2019 compared to 2018. That's pretty significant. But realize that again, December typically is a lower month for sales activity, seasonal adjusted, of course. Median sales price was up to $274,500. That's a year-over-year up almost 8%. And we've dropped down to 3.0 months of sales inventory, housing inventory that's out there, which it was 3.7 months, 3.7 months worth of inventory last December, so 2018. So we've lost a little bit of headway there. So of course, Lawrence Yun, NAR's chief economist, says, hey, I view 2019 as a neutral year for housing in terms of sales. Well, it was pretty much the same, so it's neutral. Home sellers are positioned well, but prospective buyers aren't as fortunate. Low inventory remains a problem, with first-time buyers affected the most. And we've talked about that for many videos. That is it inventory, is it price point, is it a little bit of both? I think we're seeing a little bit of both. But again, when we start looking at the detailed information here, which I've got the information, I'll post this in the description section of the video, by the way, the link so you can get to it. So when it boils, I just look at a few statistics here. So I look at the market conditions. We essentially have first-time home buyers making up 32% of the overall market. That was up 1 point from 31 the year before. Sales to investors were 15% of sales, same as last year. Cash sales were down 20% 20% opposed to 21% the year before. And distress sales actually uptick. Normally it's 2%. Distress sales ticked up to 3% of sales. And that was the same as this time last year. With the distress sales, I always like to make sure people understand that's real estate owned or bank held inventory of homes they foreclosed on make up a portion of that, as do short sale transactions. We typically find that towards the end of the year, we may see a little bit of a pickup on distress sales because lenders want to get them off their books by the end of the year. So that's why we see a marginal increase. Well, if you think about it, it's normally 2% and it's gone up to 3%. That's a 50% increase if you think about it. But on the overall scale of things, 1% out of 100 is not much, but compared when you're comparing the distress, it's actually up considerable for this 1 month. So it'll probably change come January. Existing home sales by region. The South always leads, 43% of sales were in the South, 23% in the Midwest, 21% in the West, and the Northeast had 13% sales. And if we go down to our sales breakdown by price point, the 0 to 100K is about 8% of sales. 100K to 250K range is 38%. 250 to 500K range is 38%, and the rest is, another 16% is everything above $500,000. So what we always see is that sort of sub 100K really gets pinched, only 8% of sales. The affordable housing, 100K to 250K, still always does well, but we see there's less and less sales in that market segment. Reason being just because of lack of volume, simple as that. So total existing home sales percent change. We see, again, we just see that segment getting hurt over and over again with respect to percent change. That's all I wanted to say. Okay, so here we go. That was the existing home sales. Again, when as Lawrence Yun from NAR said, the same as the year before. So we just had a year that was not spectacular. We didn't gain, didn't lose, kind of maintained the same pace with respect to sales volume. Now, let's go to housing starts. So, of course, every month the U.S. Census Bureau puts out information on housing starts. And housing starts are considered contractual signings. So I go into a builder, I sign the dotted line, I'm now a housing start. So now it's a contract, it's a house that's going to be built that will be closed on in the future. So U.S. housing starts soar 16.9% in December to a 13-year high. So let's all raise the flags and jump around because that's good news. So again, it's a 13-year high for U.S. home building activity. The data suggested the housing market recovery was back on track amid low mortgage rates and could help support the longest economic expansion on record. I'm going to say let's talk about this a little bit here, so don't be jumping for joy too much. Remember that new home sales roughly is about 10% of the overall residential real estate market. So even though the new home sales had a great uptick in contractual signings, it's not a closed sale as of yet, and it's only 10. It makes up 10, and this segment makes 10% of the overall marketplace here. So please keep that in mind. So housing starts roared 40.8% on a year-to-year basis in December. Again, December being typically a slower month, so when there is a significant increase, it's going to show better with respect to the numbers. All right, an estimated 1.29 million housing units were started in 2019, up 3.2% from 2018. So 2019 saw a slight uptick, which is great, 3.2%. But again, permits can fall too. So permits are, builders go out and actually get permits to build in the property. That fell 3.9% in December. So there you go. So what it boils down to, let me take a look at this, is single-family home building, which accounts for the largest share of the housing market, jumped 11.2%, which is great in December, highest level since June 2007. And single-family housing starts rose in the Midwest, the populous South. They, however, fell in the Northeast and the West. Now, starts for the volatile multifamily housing segment vaulted 29.8% last month, and that's your scoop. So don't forget, when you take a look at overall housing, multifamily is included, and if multifamily has a good month, it brings the numbers up. I'm not trying to manipulate statistics here for my own benefit. having new home sales is great, but again, realize that when you actually start digging into the numbers, things don't always look as they appear as to how it's reported with a tag or a headline. And we also know that next month what we'll see is that because this is kind of volatile data, the numbers always get revised next month. So in January numbers, we're probably going to see December's numbers revised, and it could be better or it could be not as good with respect to how they revise their numbers. All right, so just keep that in mind once again. So which brings me to mortgage rates. So mortgage rates fall to the lowest level in 3 months, but this could be a double-edged sword for home buyers. So why do we say that? Well, of course, everybody likes to talk about your mortgage rates and the fact that homes are more affordable. We know that's a myth that we always like to debunk here on this channel. Homes are not that much more affordable. In fact, they're not affordable when mortgage rates drop. Your buying power increases. You're still paying the same price for the home, whether your mortgage rate is 4 or 3.6%. It's just your payments change. So let's make sure we're all aware of that here. So mortgage rates slid to their lowest level in 3 months this past week, which is great. But the persistent low rate environment could have some repercussions for people looking to buy a home. And why they mention that is, again, we go to home buying power. So home buying power in December was 12.5% higher year over year, largely due to a combination of low mortgage rates and an uptick in annual household income. But low rates also mean that people are staying in their homes longer. Falling mortgage rates can help incentivize homeowners to sell their home and purchase a different home, but persistently low mortgage rates can have the opposite effect. So I don't really have to go, because many existing homeowners either bought property when rates were low or took advantage of the recent dip in rates to refinance. They are now sitting comfortably with historically affordable mortgages. That could make them less likely to move because it's unlikely they'd see much financial benefit in the form of a cheaper mortgage, meaning the choice to move will be driven by other factors such as higher income or an expanding family. So there you go. So yes, the rates are lower. It's giving people opportunity to buy homes. It's not making them any cheaper, the homes. And this is a really important part, because we know that when you refi, you typically refi, and if you're going to refi, well, you don't plan on moving. So let's take our money. It's either get a better rate, so rate and term, so we're paying less per month, or let's take out our equity, because again, recall many times we've spoken about how the equity this year has grown to record high. So the more equity we have, so we end up 2019 with trillions and trillions and more in equity. With lower rates, what do people do? Let's go and tap that equity and take that money out for whatever. And we've also spoken about some analysis on the refis, the cash out refis. A lot of the money is not designated for, we'll say, house improvement to improve the value of your home. It's actually designated to paying off bills or making larger purchases such as cars or luxury items. So keep that in mind. So again, lower rates does not always have the effect of buying frenzy. All right, now this is interesting, and this is why when we go to the housing crisis, housing bubble, people talk about that. Do we have a housing bubble? Yes. When home prices are unaffordable, it's a bubble. You can debate that as long as you want with me, but we have a bubble. When certain things happen at the peak of the bubbles, that's where I like to say we have a housing crisis. So when people say, well, will we have a bubble or the bubble burst? Well, it's a difficult question to answer. Why? Because the Fed and other people involved here in the housing industry are propping the market up. If rates are low, we're going to see housing continue to decelerate slowly as far as values are concerned, and as low inventory still will have some competition with respect to purchasing a home, and it can still maintain higher values in specific locations. So we know that. Well, to me, this is, I can list off a number of reasons why I believe we're going to have a housing bubble burst and get into another crisis. That'll come in the near future, all right? But right now, here's something that's going on that helps to perpetuate this market and what is happening right now, which only is going to end up down the road, hurting us down the road, as I said. So CFPB is planning to eliminate the DTI requirements from the QM lending rules. So there's three acronyms I spoke of right here. Let's break this down. CFPB, Consumer Finance Protection Board. Why was that created? Well, it was created after the last housing crisis when we had the mortgage meltdown to put in place stopgap measures so that people would not be tricked or falsified into purchasing homes with mortgages they could not afford and didn't understand what was going on. So the CFPB designed a bunch of rules and reporting structures and elements that lenders have to adhere to so that people weren't being hoodwinked into property they should never have bought in the first place. So that's why the CFPB, so Consumer Finance Protection Bureau, you can read a lot about that. They were responsible for the Dodd-Frank Act and other things as well too. So there you go. They're trying to eliminate DTI. DTI is debt to income ratio. It basically looks at your total income that you bring in as a household versus your expenses that are associated with maintaining your house, which are mortgage and things like that, mortgage, tax, insurance. So the whole idea that the DTI really is designed to make sure that there's a level where you shouldn't go over on your debt to income ratio. That means you should qualify for a mortgage. If you're over that level, it means your housing cost is too much, which means your ability to pay or repay has been compromised, which means you're not really a good, I guess you say, good fit for either that mortgage or that price point of home. And QM stands for qualified mortgages. So a lot of the people that are out there that even watch this channel, and again, I'm not insulting you, I'm just telling you how I feel, because I'm entitled to my opinion, you're obviously entitled to yours, is the fact that people believe that we're not going to have housing issues or housing crises in the future because of qualified mortgages. Well, qualified mortgage really is a mortgage that adheres to specific standards. But what we see here is that we see that the CFPB, so this is a governing body here, is actually going to Congress saying, let's get rid of the debt to income ratio component of the qualified mortgage. So therefore, we don't have that component. Let's replace it with maybe something else. So to me, this is another red flag, and this is this is how the powers that be, the government, etc., helps perpetuate the market and may lead us into another financial situation. So, if you remove debt to income ratios, you're allowing people to spend more for their housing expense on their income than maybe it's safe, which means they could get themselves into other problems. You're also opening the fact that, if we have lower inventory and prices are still fairly high, that by doing so, you're allowing people with low mortgage rates to increase their buying power, which means maybe they're moving up a level of buying a property they really shouldn't or couldn't afford or just stretching to afford, which could put them in a precarious situation. So basically, now we've talked about this before. Over the last several months, a number of the nation's largest lenders and housing trade groups have called upon the CFPB to make changes to the ability to repay qualified mortgage rule. That's the DTI component of the QM qualified mortgage rule. More specifically, Bank of America, Quicken Loans, Wells Fargo, Caliber Home Loans, along with the Mortgage Bankers Association, the MBA, the American Bankers Association, the National Fair Housing Alliance, and others have asked the CFPB to do away with the QM rules debt to income ratio. So this is not little offshoot banks here asking for this. We're talking B of A, Quicken Loans, Wells Fargo, which are probably your three, we're talking two of the top three banks, and Quicken Loans, which is probably the number one, we'll say, mortgage originator going on right now, asking these guys to remove this. So basically, the CFPB had sent a letter to Congress last week saying that the CFPB has decided to shift away from the DTI standard. Let's get this. So they're going to shift away from DTI standard and go to a different alternative way of measuring pricing and someone's ability to repay. So the proposed alternative would be intended to better ensure that responsible, affordable mortgage credit remains available to consumers. Okay, interesting. So how that's going to play out, I don't know. Now remember that debt to income ratio back a while ago was 36%, and then for a qualified mortgage, and it was actually increased to 43%. So the whole idea is that you don't increase it over the 43% of income. Well, we know that Fannie Mae and Freddie Mac have had what's called the QM patch going for a couple of years. So they've been exempt from that 43% debt to income ratio limit. So what the CFPB and these other banks and lenders are saying, the fact that, well, the government has had, for VA loans, Fannie, Freddie, FHA, whatever, the government's had an advantage over them in originating loans, so they want that same advantage too. So hey, better yet, why don't we just not even give us the advantage? Let's just remove the DTI requirement altogether, and we'll put something else in place and see how that works. All right. So basically, the federal housing FHA believe, they're saying that the QM patch gave Fannie and Freddie an unfair advantage because loans sold to them did not have to play by the same rules as loans backed by private capital, which is true. So, of course, everybody wants the same standing right now to get rid of the QM patch. And the QM patch is actually due to expire a year from now. So January 2021, the QM patch for Fannie and Freddie is supposed to go away, all right? But that may not be the case because the CFPB is considering extending the deadline. So they basically want that deadline extended for Fannie and Freddie. And they want the other guys to jump in and have the same QM patch, or they'll remove the rule for debt to income. And then they want to look at a new solution to support an alternative way of measuring the ability to repay here. So basically, just so you know, CoreLogic did some analysis of this. So it showed that the QM patch accounted for 16% of all mortgage originations in 2018, which equals $260 billion in loans. So 16% of 2018 mortgages were issued under this QM patch, which means didn't have to adhere to 43% debt to income ratio. You could actually go above that. That's 2018. I'm going to guess that we're probably going to see the same amount, if not more, for 2019 when they get their numbers together. So for me, that's is this an issue? Well, think about it. What we're doing is we're at the height of the market again. We haven't seen. We're starting to see a little bit of slide in housing values in specific locations across the country. So we know it's going to come at some point in time, and we have low mortgage rates. So we don't have, and ARMs and all these other, I'm not going to call them funky loans, but some of these interesting loans are making a comeback now. And the non-banks, we'll call the guys like Quicken Loans and Caliber Homes, like these guys who are non-banks and don't have the same reporting structure, are looking for the QM patch to be removed as well. So you see, we can see that it's all kind of building now. And really what it boils down to, this is a funny article, it's like, here we go again. The mortgage industry seeks to eliminate debt to income ratios for home buyers. At the peak of every boom comes one final act of repetitive stupidity, and this may be it. This is exactly what I've said. So what's happened the past couple of years with low rates? Refinance, cash out refinances, okay? Not good. You basically go up high in your loan to value as far as you can. You take money out, you're going to be stuck if there's a shift in housing values. And again, with respect to lending, so all those people who say, no, we don't have problems with lending, we have QM qualified mortgages, so we don't have the same problems. Well, we do have the same problems. They're just being maneuvered a little differently. And now we're actually having government bodies going to Congress saying, hey, let's just get rid of it. Let's just do whatever we want. We don't care anymore. We'll find a better way to report on this. We'll figure it out. But right now, let's extend this. Let's do it. So I look at we're going to have one more year at least of this 2019 until the election. We're going to see a lot of this going on. Let's prop the market up. Let's keep the rates low, maybe reduce them a little bit, and we're going to allow more people to buy, and let's keep this thing going. That's what we're going to see this year. And this to me, and I love this line here, going at the peak of every boom, because comes one final act of stupidity, and we're allowing it to happen right before our eyes. We can go back in time and see what happened before, but we're ignoring it right now. So to me, it's like whatever. Everything kind of goes now. That's my take on things. It's just, and to me, this is just what's going to happen. And we know that there's more subprime coming. We know that credit scores are dropping. So things are being manipulated and maneuvered here. We're going to see more people having issues with their loans. So I guess basically, again, it's just, what can I say? Will it stop here? Who knows? Maybe we'll see more ninja loans. Ninja loans are no income, no job, no assets. Because we tried them before too. That's what the article says here. So a little bit tongue in cheek, but the point is that, what are we going to do, right? What's going to happen? I know what's going to happen. I know how it's going to play out exactly. And I think we all need to get prepared for that, because this will just cause more people to have issues. There'll be more financial issues, and people will have more non-payments, and we'll see more pre-foreclosures happening as the year goes on if stuff like this continues. Why do I know that? Because I see the statistics where I live and where I analyze, and we also know that there is an increase in, we'll call it, more recent vintage loans having quicker default rates than older loans. So the world's changed, guys, and we're going back to what happened a number of years ago. I call it like I see it. That's how I want to call it. If you agree, that's great. If you disagree, it's up to you. I don't think that qualified mortgages are taking us to the promised land, that every buyer can afford a house, every buyer is going to be a great credit score, good DTI buyer. It's proven it's not going to happen. It's proven here that lenders will do what they need to do to originate loans to keep this market moving, and then we'll deal with the consequences later. That's my take on things. So anyway, guys, appreciate, again, once again, thank you for getting me to 10,000 subscribers. I really appreciate that. If you're not a subscriber, please click the button and subscribe. Help my channel grow. Helps me to continue putting out this type of content, which I do appreciate you doing. Thank you once again for the views, the likes, the comments. Please share the video with your friends and family. Once again, reach out to me for information on real estate training courses. I've actually made some improvements on that, adding some more into it. So I think it's a better program now than it was before. If you're looking for investment property, I get lots of opportunity here in the Tampa Bay area, a lot more coming my way, other locations in Florida as well too, which is about networking and getting property that comes through my door as well. I also have involvement in multifamily. I've got some great, we'll call it suppliers of lists that I can hook you up with on the multifamily side as well too. And again, there's going to be some criteria. You have to show that you can. I'm just not giving lists away for you to sell and do your own thing. It's like if you're a serious buyer or serious investor, contact me. I'll certainly help you the best I can. We'll figure something out. Also, if you're interested in private lending, because it's something that I know exists. I've never actually asked people from the channel here, but a lot of people who want to invest also are looking for private lending options that are out there. And so if you are looking to be a private lender, I can certainly help you with that. I have lots of applications and opportunities right down here that are secured by decent property in my area. So that's the scoop. Give me a shout, reach out to me, send me an email, please. Also, please put in your telephone number. A lot of people email me, don't give me a contact number. So please put in your phone number, and I appreciate that. So again, everybody, thanks very much. We'll look forward to speaking with you early next week.